Thank you to Professor Nisam and Melina for giving me the opportunity to present my work here, and thank you to all of you for coming to see it. It's always difficult to follow in Professor Harris's footsteps, but I'll try my best. I'm an assistant professor in the accounting division, and I'm going to talk about the impact of fair value measurement on systemic risk in the banking sector. It's based on much of the research that I've done since graduation. And I like this area a lot because a lot of time people think accounting really doesn't matter. And you will take many classes. You all have to take the core accounting class. I teach that. I also teach a PhD class in banking. But many times people come up to you and like, we really understand what you're doing, but does accounting really matter? And these papers or this research actually shows that accounting can have serious consequences for bank valuation and overall economic stability about how it can interact with certain other frictions. So the stuff that I'm going to show you today is based on 3 of my papers. And if you want more details, you can always go back to my website and you'll find that. So before I jump into how fair value measurement in particular can increase bank contagion or risk to the banking sector, let me explain to you what fair value actually means. Different people have different ideas what exactly fair value means. Most commonly, the view that's held is that fair value is actually market prices of assets and liabilities or marking to market. However, FASB has a very particular definition of fair value in their mind. What they define fair value is, it is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So there are many things to it, but probably the most important part of this definition is that it is a price from an orderly transaction. And this is, while fair value itself is defined in this accounting standard FAS 157, which came out around 2007, the definition has been there for a long, long time. It's not something new. And according to FASB, which is the accounting standard setting board for the financial accounting standard setting board, there are 3 different kind of fair value measurements. It could be a level 1 fair value measurement, a level 2 fair value measurement, or a level 3 fair value measurement. A level 1 fair value measurement is what many people refer to as marking to market. So if a certain asset or liability trades in an active market, it is the price for that asset or liability. Examples of this include actively traded equity securities, listed derivatives. So again, if there's an active liquid market, you can use the price of that asset or liability, and that's a level 1 fair value. However, there are many assets and liabilities that do not trade in active markets. So then you can have a fair value measurement which is either a level 2 measurement or a level 3 measurement. A level 2 fair value measurement is a valuation measurement which is based on market observables. So here is the case where you have an asset or liability. It does not have an active liquid market where it's traded, but there are similar assets or liabilities which are traded in active liquid markets. So you can take certain inputs from their valuation to come up in the fair value measurement for these assets and liabilities. Examples of these are restricted stock, corporate and municipal bonds that are fairly illiquid, and some OTC, over-the-counter derivatives. Coming to level 3, which probably has been the most controversial fair value measurement, is valuation which is based on unobservables or marking to model. Many people even refer to this as marking to myth. So these are assets and liabilities that are not traded in active markets, do not have similar assets and liabilities which are traded in active markets. And essentially, the valuation is based on certain models which are used by the management. Examples, private equity investments, certain asset-backed securities, much of the mortgage-backed securities which were at the heart of the recent financial crisis are actually measured using level 3 fair values. And some very complex derivatives are there. So this is fair value. And the next question, if you followed what happened during the crisis, many things were blamed, and fair value accounting was one of them. And if you just read that, fair value accounting is bad, one thing you would question is that, okay, if fair value is so bad, why does FASB, the accounting standard setters, why are they so crazy about it? Why are they so passionate about it? Why do they really want fair value to be used? So there is a reason, or I could say there are certain beliefs that the standard setters hold. They believe that fair value accounting provides more timely and relevant information about future cash flows and future earnings of a corporation than accounting based on any other measurement basis. And one of the papers that I mentioned, the one that's co-authored with Professor Bratton and Kaushali, we actually investigate this. Is it the case for a sample of banks that fair value provides more timely and relevant information? And we find that adjustments, fair value adjustments, which are embedded in banks' financial reporting, do actually help to predict bank earnings up to 2 years ahead, compared to, better predict earnings 2 years ahead compared to historical cost or amortized cost. But there's an important caveat there. The fair value measurement has to be reliable. If that fair value measurement is not reliable, it's not clear whether it actually provides much benefit over some of the other measurement bases. FASB, on the other hand, does believe that fair value accounting is the way to go forward, and especially with respect to financial instruments, their long-term objective, especially until the financial crisis and even now perhaps, is that all financial instruments reported on the balance sheets, all financial instruments held by financial institutions should be measured using fair value. And consistent with their beliefs, you see that the use of fair value accounting in financial reporting has increased significantly. So what I have for you here is, I'm trying to get an idea of how extensively is fair value accounting actually used in financial reporting. So I'm graphing here is the sum of assets and liabilities that are recognized or disclosed at fair value by all the banks these all US bank holding companies, scaled by the amount of loans held in the banking sector. So this gives you a sense that as a proportion of all the loans which are not reported at fair value on the balance sheet, they're disclosed, the fair value is disclosed, how is the use of fair value evolved over time? So if you see early on, it wasn't that much, but there are many standards that have come by that have mandated the use of fair value accounting. And over time, this use of fair value accounting has increased significantly. So there's some validation that as consistent with FASB's objectives, they have passed many accounting standards which have required fair value to be used in financial reporting. And we observe that in the data as well, that the use of fair value accounting over time has increased significantly. So far, all good stuff about fair value accounting. It's good, it helps you predict future earnings, it's wonderful. If you have this in financial reporting, you can get a better sense of what the bank's earnings will be. But then there's a dark side to it, or potentially a dark side to fair value measurements as well. And during the financial crisis, pretty much everything was blamed for the financial crisis. You drive people who borrowed loans were driving too fast, this, that. Every single thing out there was blamed for it, and accounting happened to be one of them. The reason behind that was that under certain circumstances, fair value accounting can interact with other frictions to increase contagion among banks, which will essentially increase the systemic risk. So IMF came out and said that investment decisions based on fair value accounting could lead to these downward spirals, self-fulfilling fire sales, where prices are falling and then people are selling more assets, the markets are liquid, prices are falling further, which can actually create systemic risk in the banking sector. Bill Isaac, who was the chairman of the FDIC from 1978 to 1985, actually came out and said that he believed that fair value accounting caused a financial meltdown. So he was sort of on the extreme side. Most people said that fair value accounting could have contributed to the crisis. But Bill Isaac, who actually sort of saw the transition in the accounting rules from the historical cost or the amortized costs to fair value, believed that fair value accounting caused the financial meltdown. So how exactly can fair value accounting cause bank contagion? There are many different channels out there through which fair value accounting can contribute to bank contagion. I'm going to talk about a couple of them, but there are many more out there. So the first way or first channel through which fair value accounting can contribute to this contagion is by interacting with solvency ratios imposed by regulators. So the setting here is, let's say a bank is exposed to a certain shock, which causes the prices of its asset to fall down. Under a fair value accounting regime, those assets will have to be marked to the whatever the fair value is, which has fallen now, and now there's a potential that it might be violating those regulatory ratios. As a result, the bank has the incentive to sell certain assets to shore up its regulatory ratios and avoid being shut down by the regulators. What happens during this time is that as the market is illiquid, forced sales put downward pressure on the prices of the asset and cause the price of the asset to decline further. Other banks in the economy which are required to follow fair value accounting, now the new asset prices becomes the mark for them. So initially, while the other banks did not have a regulatory constraint, were not constrained by the solvency ratios, because of the actions of certain banks, because of the further fall in the prices, they might feel constrained, and as a result, they might have incentives to dispose of their assets. So it becomes a sort of downward spiral of asset prices falling, which can increase bank contagion and threaten the entire system, the banking sector. Another story, another channel through which it can happen is, yes?
Just to add to that, if you believe that, as the bank, you're going to try, as soon as you start seeing it, you're going to try and get it first.
Yes.
So actually it happens
even faster, yeah.
Because actually you've got to realize it even before the value goes down, so the value can overshoot.
So there's sort of a rush to the market. You sort of want to be the first one out of the door because as the orders are executed, the prices will keep falling. So that's absolutely true. It's not just that there's also who's the first one to actually trade their assets. Another channel is through how fair values are determined during illiquid times. When the market is active and liquid, you expect security prices to reflect the value of the underlying fundamental or based on the underlying fundamentals. When there's illiquidity in the market, the asset prices actually reflect the amount of liquidity in the market rather than the true value of the underlying fundamentals. And as a result, a bank which is otherwise solvent might be considered insolvent by the regulators. Again, an insolvent bank might be shut down, causing asset disposal, illiquid market, the price of the assets are falling down, other banks are required to mark their assets. So again, the same story of a spiral of falling prices and sales, which can cause this artificial volatility and risk in the market, resulting in increased systemic risk. The important thing is that if there was a regime, an accounting regime that was based on historical cost or amortized cost, you would not observe the same phenomena. So these are just two of the channels. There can be many other channels. You don't really need the presence of a regulator for fair value accounting to result in bank contagion. If managers are concerned about reporting higher accounting earnings, which they should be because accounting earnings is an important input in their compensation contract, they can have the same incentives. They don't want to observe these losses, don't report these losses, so they have an incentive to be the first one out of the door when market prices are falling. Or other investment decisions, debt contracts, to the extent that they're using fair value, in certain circumstances, fair values can interact with these other frictions to result in these downward asset prices and sales. So what I do to look at the role of fair value accounting in banking crisis, I sort of examine, okay, is there sort of an association between the use of fair value accounting in financial reporting and bank contagion? Is this association stronger during illiquid times? Because that's when you really should be observing this, because when markets are illiquid, they can't sort of absorb these additional sales. And further in the cross-section, are certain banks more susceptible to this sort of contagion, the contagion through the fair value channel? Is it the case that banks which are poorly capitalized and have stronger incentives to sell when asset prices are falling, are they more affected by this contagion? Or banks which hold a larger proportion of fair value assets. Because if you're a bank that doesn't really hold much fair value assets, then it doesn't really matter because whatever's happening in the market, you're sort of immune to that. So to do this, I use the bank holding company database, which basically comprises of all banks above a certain threshold providing their financial disclosures to the regulators on the Y9Cs. And its intersection with the CRISP database, which has the equity prices for all the banks. My sample period extends from 1988 to 2007. I sort of end in 2007 because that's when the fair value rules were relaxed, they were changed, and the last paper that I'll show sort of picks up on that, how the change in the accounting rules for fair value accounting had an impact on systemic risk. And I end up with about 793 bank companies, lots of observations. And how do I do this is, I use a model, a logit model, where I see the association between extreme neg, which is a measure of extremely poor stock returns for an individual bank. So if a bank is having extremely negative returns over its time series of returns, this is an indicator variable that's coded as 1, and I see its association with debankrupt, which is another indicator variable, which captures the extent of problems in the banking sector. It is based on the equity returns of money center banks, which are the most important banks in the economy. So when they are generally doing well, it's sort of a proxy that, okay, the rest of the conditions in the banking sector are pretty bad. So, and then I see, using FV all, which is my measure of the extent of fair value reporting in the financial system, how that has altered the relationship between poor performance in the banking sector and the really bad performance of the individual bank. So what I'm interested in is whether the contagion from these money center banks has increased when you have more fair value based financial reporting. So the coefficient, or the thing that's of interest to me, is the interaction between debankrupt and FV all. Debankrupt sort of captures all sort of other contagion because of counterparty exposures, other reasons why contagion might exist in the banking sector. And many studies have shown that contagion exists. But what I'm trying to look at is whether fair value reporting has increased the amount of contagion that's there in the banking sector. So that's why my coefficient of interest is the interaction between debankrupt and FV all. I'm not saying that fair value is the only reason why contagion exists. There are many other reasons why contagion exists. And then what I'm presenting to you is sort of a condensed model of what I do in the paper. If you go look, it's a very extensive model with many, many variables trying to control for all sort of things that are happening in the banking sector. So what I find is that, yes, there is contagion in the banking sector, which is sort of captured by debankrupt. This is nothing new. Many studies have shown that. I'm not the first one to show that when the poor performance of the money center banks, individual banks are likely to do bad. However, as financial reporting using fair value measurements has gone up, the contagion from the money center banks to other banks in the economy has increased significantly, which is captured by this interaction, the coefficient on this interaction. The next step that I do is, okay, on average, I find that fair value accounting is associated with an increase in contagion in the banking sector. But is it the case that this contagion only shows up when asset markets are liquid? Because remember, both the stories that we have, or most of the channels work, when there's some sort of a price pressure. To the extent the markets are liquid to absorb additional asset sales, you really should not observe this contagion. So I create another variable which captures the illiquidity in the asset markets, and I interact that with my fair value contagion channel. And what I observe is pretty interesting. I see that when the markets are liquid, there is no evidence of contagion from fair value measurements, which is what you would expect, because that's when the asset markets are liquid and they're able to absorb these additional sales. However, when the markets are illiquid, there is evidence that fair value accounting contributes to contagion in the banking sector and potentially increases systemic risk, or the risk of the breakdown of the entire system. I don't have the other two results in the slides, but I also find that the banks which are most likely to be affected by this new fair value contagion channel are the ones which are poorly capitalized, which makes intuitive sense because they are the ones which are most bound by the regulatory capital constraints. If you're a well-capitalized bank, then it's less likely you have there's more room to absorb shocks to the asset prices. Similarly, banks which hold a larger proportion of fair value asset are the ones which are most affected by this fair value contagion. So far what I've shown is that from 1988 to 2007, there is evidence that increased use of fair value accounting is associated with this increased contagion. The pushback that I would often get when I would present this paper is, well, can you show us some causal relation? Is it the case that there could be so many other things happening? You have a 20-year period, so many other things could be happening. And in my model, I sort of control for many of those things, but people are not convinced a lot of times by just including control. So that was my motivation for doing an event study around certain changes to fair value rules. So what happened going into the financial crisis? The fair value standard was there. And if you remember, I showed you level 1, level 2, level 3 fair value measurements. The problem that was happening, that to the extent fair value was applied as the regulators want, not the regulators, the standard setters wanted it to be applied, you could argue that you should not have a fair value contagion channel. The reason being that if there's an illiquid market, there is no reason to use level 1 fair values, because level 1 fair value measurement is to be used when asset markets are liquid and deep. Anytime the markets are illiquid or there's not an orderly transaction, you actually move away from level 1 and level 2 fair value measurements and you use level 3 fair value measurements. The problem that was happening is the guidance that was given around the existing standard and some of the studies which are put out by auditors, the conclusion, or at least the impression that those studies gave, was that it is preferable that despite the market being disorderly and the market being illiquid, that the illiquidity discount should be used in coming up with the prices of assets. So essentially, despite the flexibility given between level 2 and level 3, auditors to some extent were forcing banks to use fire sale prices to report their assets and liabilities. And part of this is to safeguard themselves against litigation, but that's what was happening in the economy at that point in time. So FASB decided that they need to provide more clarification, and they decided to relax the application of fair value accounting rules. So what they did around this time is they came out with 3 new financial statement positions, which basically gave additional guidance about when to consider the asset market illiquid. So that gave the auditors exact indicators. Okay, if we observe X, Y, Z, we can consider the asset market illiquid, and we can use a level 3 fair value rather than a level 1 fair value. They also eased the asset impairment rules, which allowed banks to reduce the hit that the accounting earnings took when an impairment was recorded. So what we do in this paper is we see, okay, what is the stock price impact around these events? So we identify 10 dates where important decisions are taken, and we see what is the average stock price impact of the banks around these 10 event dates. And further, we condition that stock price impact on individual banks' susceptibility to contagion. So if a certain bank is more likely to be affected by that contagion, then we expect those stock price reactions to be more positive for these set of banks. Similarly, there are certain other characteristics, bank-specific characteristics, which make them more susceptible to contagion. Example being, if you have a larger portfolio of illiquid assets. So easing of fair value rules actually helps those banks more. And then we examine what the stock price reactions are around these 10 events, 10 important events. And essentially what we find is that controlling for other determinants of bank returns, there's a significantly positive stock price reaction around these 10 events, which sort of complements findings from my other paper saying that the stock price market participants perceived fair value accounting to be hurtful to banks, and the easing of fair value accounting rules was actually beneficial. We also find the banks that benefited the most were the ones which were susceptible to contagion and held more illiquid assets, further providing evidence that perhaps it was the contagion channel through which these fair value accounting rules were hurting the banks. An important thing to keep in mind is we also look at the bond reactions, because it could be the case that the reason you observe a positive stock price reaction is because there's wealth transfer from the bondholders to the stockholders. But that's not the case, because even bondholders actually have the CDS, we use the CDS prices to actually run that event study, and there's a positive reaction in the CDS market as well. So it is not the case that it's a pure wealth transfer from the bondholders to the stockholders, but actually the stockholders perceived that the fair value accounting rules were hurtful to the banks during that time. So in sum, based on these papers, what we find that fair value measurement or accounting for banks can have serious consequences for bank valuation and overall economic stability, to the extent that an accounting regime that is more fair value oriented has the potential to increase contagion in the banking sector, especially during periods of market illiquidity. The banks which are most likely to be affected by it are the ones that are poorly capitalized or more fair value oriented. And the evidence from the event study suggests that at least the stock market participants and the bondholders perceived that the fair value accounting rules in place during the financial crisis were hurting the banks at that point in time. Okay? So that's all I have. Thank you.